Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to get very valuable information from the gentleman I'm interviewing today. His name's Thomas Castelli, and Thomas is with Hall CPA firm. And I've actually been on his podcast. He's got a podcast, and he's a tax strategist and CPA. And we're actually considering using him ourselves. Welcome to the show, brother.
Oh, thank you for having me on, Rod. It's an honor to be here.
Well, thank you for saying that. Well, I know you're also a sponsor on a deal in Jacksonville. Is that where you guys are located? I can't remember.
Yeah, so we're a virtual firm, so we're all over the United States. But I did a deal back in Jacksonville back in 2017, which I was on the sponsorship team. So
nice. Well, that market has gone crazy. I looked at an asset out there recently, and it's just insane what's happened rent wise. But why don't you maybe introduce yourself a little better than I did? Talk about your story a little bit, maybe even, but then, let's get into, just real briefly, but then we'll get into, some of these tax strategies that you listening may or may not be aware of.
Absolutely. So kind of quick background on me. I went to college for accounting, and kind of when I was in college, I kind of realized that, the whole 9-to-5 thing wasn't going to get me to where I wanted to go. So I started reading books, the Rich Dad, Poor Dad, that entire thing. Rod, I think your book came up in there at some point. And I was like, okay, real estate is going to be something that I need to focus on. So I ended up going to a 3-day weekend after I graduated college and learned all about syndication, really fell in love with that business model. Started attending meetings, networking, all of that, and invested as a limited partner in a handful of deals. And then someone who basically became like a mentor to me said, hey, look, if you ever find a deal, we'll syndicate it and we'll make it happen. So I ended up, banging the phones, all of that, down in Jacksonville. And I did find an 82-unit apartment complex that we did end up syndicating back in 2017. And that was very exciting. And then we ended up exiting that deal back during the pandemic, which was also an interesting situation. And so that was kind of how I got my start on the investing side. And then around the same time that deal actually happened, I ended up meeting Brandon Hall, who is the founder of the firm that I'm currently working for. And I found him on LinkedIn. He was always posting about real estate investing and taxes and stuff. And I'm like, hey, I'm investing in real estate. I'm a CPA. Would love to see if there's some synergies. So next thing you know, I'm at the firm. I'm a tax strategist. I'm working with clients, consulting with them on how to minimize taxes. Which is also very exciting. And, today I'm a partner at the firm, and I have an advisory team that works with clients to help them minimize taxes. So it's definitely been an exciting trip.
Nice. Well, so you know what? Let's just get right into, again, some of you listening are aware of the fact that real estate's probably the most tax advantage vehicle you can possibly get involved with. There's a reason 90% of the millionaires out there either did it through real estate or invest in real estate for tax reasons. But let's talk about some of the benefits. So why don't you take it away, and I'll just interject.
Right. Okay. So I'm going to start just by breaking down kind of how real estate tax works and why it's so beneficial, right? So way back in the 80s, there was the Tax Reform Act of 1986. And what that did is it made rental real estate passive by default. So that means that all the losses that you get from rental real estate can only offset your other passive income, which is typically for many people going to be rental income. And these losses are generated by this non-cash expense called depreciation. And the best part about depreciation is it reduces your taxable income, but it does not reduce your actual cash flow. So I always give an example. Let's just say you had $100,000 of rental income, right? And you had $60,000 of hard expenses. This is repairs, maintenance, property management fees, utilities, property taxes, so on and so forth. Now you're left with $40,000 of cash flow. Well, that would also be taxable income, but now we have this depreciation expense that comes in, and it often completely offsets that taxable income. So let's just follow with the example. You had $100,000 of rental income. Now you have $60,000 of hard expenses. Let's say you have a $50,000 depreciation expense, which is not even too far fetched. And now all of a sudden you have a loss of $10,000. So this enters the first benefit of investing in real estate is the cash flow is tax advantage. So you just pocketed $40,000 of cash flow into your pocket, but you're paying no taxes on it. And that's the first benefit. Now,
let's stop there for 1 second. Yeah, I'm going to tell you personally, I haven't paid taxes in 2 decades, maybe longer. When I have businesses that are profitable, then I pay taxes in those businesses sometimes, but never in the real estate. And in fact, if you love him or hate him, Trump, they wanted to see his tax returns, and he owns tons of real estate. So, damn well he hasn't paid taxes. You'd be an idiot to pay taxes. I mean, why wouldn't he take advantage of the tax laws? And so, that's why we love this business, guys. So this is, besides the cash flow, probably one of the biggest benefits associated with real estate. So keep going.
Yep. So that's the first aspect of it, right? And I'm going to get into how you can use that gain in a second. But then also, not only is the cash flow tax advantage, but so is the exit, right? There's so many different ways you can exit a property in a tax advantaged manner that you can really reduce or eliminate the capital gains tax. And obviously, the first one that everybody always thinks of is the 1031 exchange. If you do a 1031 exchange, you can kick the can down the road by buying another asset, putting the sales proceeds in it, and you just basically buy a bigger asset and not have to pay taxes, at least not now. Right. So that's one of the benefits. Another benefit of it is real estate tends to appreciate over time, and with that you can do cash out refinances or get HELOCs. So instead of selling a property, which is going to be a taxable event unless you use like a 1031 exchange or another strategy, then basically when you get the HELOC, the cash proceeds from that, the debt proceeds, are not taxable. So as the value of your real estate increases, you pull money out through cash out refinances, and you're not paying tax on that income. So that's let me elaborate on that one now.
So that's our model. We actually have 2 deals under contract right now. In fact, if you're an accredited investor, text the word partner to 72345. I've only bought 1 deal with my partner in the last year in San Antonio, Texas, 296 units, because we're super conservative. And that thing broke even day one at 59% occupied. It's even better now. And so and now we have 2 under contract. I mean, that's the effect of the recession already, is we're finding deals, phenomenal deals, and we're placing long-term fixed rate debt on them. So, super solid projected returns on this thing, on both of them, actually, one in Nashville and one in Hot Springs, Arkansas. So if you're accredited, again, text the word partner and talk to us about it. But anyway, the other piece of this, I lost my train of thought for a second, but let's dig into. I'm sorry, you were continuing. So you just talked about refi. That's where I was going with that. The reason I brought that up. So what we do in our assets, for example, is our goal is always to refi in say 3 to 5 years. Because we've done a value add, increase the NOI and increase the value, we're able to refi and get our investors. The goal is to get them all or most of their money back, and then it's infinity returns, right? You don't have any money in a deal and you're getting cash flow still. It's infinity returns, and that is a huge benefit of real estate. And in the smaller assets, they call it the Burr method. Bigger Pockets coined a method called the Burr method. You buy it, you repair it, you refinance it, and you rinse and repeat. And so, and that's a fantastic strategy in all asset classes. So anyway, I just wanted to elaborate on that real quick. So please continue.
Yeah, absolutely. So the cash out refinance is one way that the income you can get is tax advantage, because you can pull it out tax free. Now, the question always becomes, okay, well, what happens to this loss? Remember, I mentioned the loss before. You have a $10,000 loss. Well, the loss can be used in a handful of ways. For most investors, the loss will either be used to offset future income. So the loss can be suspended and carried forward into future years when you do have passive income, presumably for rental real estate. It could also be used to offset the gain on sale of the property. So what a lot of investors actually do these days is they actually don't use a 1031 exchange. What they'll do is they'll buy a new property or invest in a new syndicate. Within the same year, they sell another property, and then the new property, they'll run a cost segregation study on it. That will push up the depreciation expense. We get more into the details there, but it would push up the depreciation expense on it, increase generating a loss, and then that loss from the new property can offset the gain on sale of the original or the property you sold.
Right.
Making
And sometimes that's just as tax advantaged as a 1031, especially with, what we've had, these last year or so is the bonus depreciation that they put out there, which, as we discussed, is, phasing out right now. But why don't you let's drill down on cost segregation a little bit. Talk about what that means.
Right. So when you buy a property, if you're buying residential property like multifamily, the property is typically going to be depreciated over 27 and a half years. Mm-hmm. So roughly speaking, 127.5 is just deducted every year. But what cost segregation study does, it's an engineering study where an engineer comes down to your property and they're going to break down the components of your property, because the property you buy is not just the building. You have appliances, you have fixtures, you have carpeting, you have windows, all these different components. And what ends up happening is they're going to break it down into 5, 7, and 15 year class, 5, 7, 15, and 27 and a half years. So you're going to have basically 4 different categories.
So what he's talking about is a remaining life on each one of these things. Okay. Right. Just to be clear. Right. Okay.
Right. So what happens is when they're going to break this all down, give you a report, and that 5, 7, and 15 year property can all be depreciated using bonus depreciation in the first year, 100%. So basically, long story short, if you buy a property placed into service between 2018 and 2022, the end of this year, when this is being recorded, you can fully depreciate the amount of the 5, 7, and 15 year property all in 1 year. Mm-hmm. So that's extremely powerful. And, generally from our experience, anywhere between 20 to 30% on average, it could go a little higher, it could go a little lower, depending on the asset, can be reallocated to these class lives and eligible for bonus depreciation. So to kind of give an example of how powerful this can be, just take $1 million asset. I know people are buying much more expensive properties out there, but $1 million, and let's just say you get 25% reallocated to 100% bonus depreciation. Well, now you have a $250,000 deduction, a non-cash deduction. So if you had that $100,000 of rental income I mentioned before, and then you had a $250,000 deduction, thanks to bonus depreciation, you're going to have a negative. And combine it with all your other expenses, of course, but keep things simple here. If that was your only expense, you're at a negative $150,000 loss, and that means you didn't pay the tax on your rental income, and now you have this $150,000 loss that you can use to offset income in future years, or offset the gain on sale of other properties that you may have, or if we can get into a little bit, if you're on the active side, it could perhaps offset some of your other income.
Yeah, we'll talk about that in just a second, but before we move to that. How is the phase out structured for bonus? Could you speak to that a little bit? You'll be educating me on this one.
Right. So if you place an asset, you place in service by the end of 2022, then you'll have 100% bonus depreciation. Right. In 2023, it's going to be 80% bonus depreciation. Okay. 2024, it's going to be 60. 2025, it's going to be 40. 2026, it's going to be 20. And then 2027, as it stands today, it is gone. There's zero. Whether or not they renew it has yet.
Who threw the phase out in? Was it the Dems or was it a Republican thing?
Yeah, so I don't.
Okay, just curious. If it was politically driven, I'm just curious because who knows? There could be a change here, and maybe it'll come back. But still, you've still got a couple of decent years. Even 60% is better than a stick in the eye. So. Right. So talk now about, and so guys, so again, just so you fully understand it, an engineer will go out and they'll look at the light fixtures, the carpet, the doors, how much remaining life is in each of them. And they'll categorize them in those buckets. And it's very powerful. I mean, I've saved hundreds of thousands of dollars literally through cost seg, even on single family, believe it or not. I had a package of single family I cost segged and was about a $600,000 loss. It was phenomenal stuff I'd owned for decades. But okay, so talk about a real estate professional and what that means, and how that is even more enhanced?
Right, right. So, kind of going back to the Tax Reform Act of 1986, when they made all the losses passive, what that meant was you cannot take the losses that you have from real estate against your active income, your quote unquote active income. So, income from a W-2 job or from an active trade or business that you might be running. But what the real estate professional status allows you to do, if you're working more than 750 hours and more than half of your total working time in a real property trade or business, then you can qualify as a real estate professional status. And then that will take the losses that you're generating and make them what's known as non-passive. So quote unquote non-passive. And basically what that means is that they can offset pretty much any source of income that you have. So if you're a real estate professional and you have a spouse who's generating a substantial amount of income from another job or another business, you can use these losses, like let's talk about the 150K loss that we just mentioned before, to offset their income. And that could be, even not only did you not pay taxes on your rental income now, but now you're reducing the tax that you're going to pay on your other sources of income. Which, if you can qualify as a real estate professional, if your spouse can qualify as a real estate professional, then you're going to be able to significantly reduce taxes on your other sources of income,
or eliminate. In my case, it was eliminate. So I mean, it's freaking awesome, guys. I mean, that's why we love this business. Let's talk about strategies that, I mean, maybe you've already covered them all, that relate to just investing passively. Maybe have you already covered all of them?
Right. So when you're investing passively, when you're say a limited partner in a deal, quote unquote, the main strategy, what the game becomes for you is going to be making sure that you're sheltering your passive income. So you might be involved in all different types of syndicates or funds. Some of them might be generating more income or cash flow than others. So you want to make sure that you have enough losses from your other syndicate interests, basically to offset any passive income that you might have, any rental income. And then also when the sponsor tells you, oh, by the way, we're going to be selling the deal this year, you're going to want to go look at, there's going to be a form on your tax return called Form 8582. This is where your passive losses are stored, for lack of a better word. And if you have enough passive losses on your Form 8582 from the prior year to offset the gain or expected gain on sale from this syndicate that's going to be sold, then you're in the clear. You don't have to do anything. But if you don't, then what you could do is you could go ahead and reinvest in another syndicate, or just invest in another syndicate in general. And assuming that the sponsorship team, they're going to have a cost segregation study run, which most do, but you always want to confirm that. Right. That the loss from this next deal that you're investing in can offset the gain on sale of the syndicate that has been sold. So that really just becomes a game of monitoring how much passive losses you have on your tax return, and then taking steps, if you don't have enough to offset the gain, taking steps to make sure you get losses in that same year the syndicate sells, so that you could keep playing and kicking the can down the road.
Nice. Well, guys, so it's Hall CPA, and if you've got additional questions on tax strategy, what did we? Is there any topic we didn't cover? I think we may have covered them all as far as real estate tax strategy. Was there anything we missed?
Yeah, no, I don't think we missed. I think we hit everything. Yeah,
awesome. Well, Thomas, I appreciate you coming on, brother. It's great to see you again, and I think we'll be talking soon. And guys, have a great day. Those of you listening and watching, take care.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345 and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.